Hello and welcome back to another episode of One Big Stock Market Sundays with me, Will, John, and Jord. How are we, lads?
Yeah, good.
Yeah,
Is that the first time you've seen that, John?
That is. I was well impressed there. Good.
I've seen your face when you was playing. So, sorry to cut you off there, Will. I seen his face when he was playing that.
No, fair enough. All good.
So, obviously, without further ado, we always jump straight in. Look at the predictions from last week, Jord.
Yeah, so we actually had a different week from the past two in the way that the points sort of winners have swapped around. So it was another red week, which is the third in a row. I think that's the first time since we started doing this. So a point for myself, Will, and Jay. Unfortunately, no points for John or for Stream. So Stream's still down there on the 1 point. Lots to talk about, as always, like big volatile weeks, big moves, and these 3 weeks have had bigger moves than the previous ones we've seen. So it's really hard to work out what's going to happen, and in hindsight always comes back and seems so obvious afterwards, but obviously we'll come back at the end to give our new predictions ahead.
And I think it's the last time we had three red weeks in a row since September 2023. Oh no, February 2025. But still, anyway, like it's been a long time because it's been mostly green over the last year, hasn't it?
Yes, sir. Will, you're going to jump straight in and do the gold, silver, Dixie for me off go. So if you want to take over from there, mate, we'll put you up there.
Yeah, so lots going on as usual, which meant that there was, again, volatility in the markets effectively. So as has been the trend over the last 2-3 weeks since Operation Epic Fury was kicked off, gold and silver have been trending downwards. So as we mentioned before, a few weeks ago now, when we spoke about Dixie at length with Kevin Walsh as well, when the Dixie goes up a lot, as it has done over the last 5 days, plus 1.66%, because people are buying the Dixie because it's a safe haven, that does tend to put downwards pressure on precious metals because they're priced in dollars. So it's a bit of like an inverse kind of like relationship. So yeah, silver down 2.09% for the last 5 days, gold down 1.34, as I said. But Dixie's shown some really good strength. So it's doing what it's supposed to do, plus 2.3% for the year. And from that 95 low, I don't know what the maths is. It's probably like plus 5-6% from there. So yeah, Dixie's doing what it's supposed to do. I'm sure it'll get sold off if and when the conflict in Iran is over. But as of right now, it's a good sign that the Dixie's strengthening, because in times of uncertainty, in times of war, in times of conflict, in times of recession, the dollar generally always strengthens because it's a safe haven. Bitcoin plus 6.33% for the week, so that's had a pretty good week. But to be honest, it's still just generally trucking around roughly sort of between 65 and 73. So it's just doing what it has been doing over the last 2 months. And as I went through quite significantly last week, again, what it did this week, even though it hit the highs of around, it's a bit small, isn't it? Sorry, guys. Even though it went to the highs of around 74-ish, it's still just doing what it generally does on the 4-year cycle in the midterm year. So yeah, a good week for Bitcoin, but I do still think we'll be trending downwards nearer the autumn for Bitcoin. And then, as last week, just temporarily, we've added in our first segment the oil prices. So oil had a big week again, unfortunately. We're up to about 99.3, but this is at the close on Friday, and as I'm about to mention, obviously some things did happen over the weekend. So we are pretty high on oil. Like, we are really, really high on oil. The last time we were here was when the Russia-Ukraine stuff kicked off. So yeah, we're not doing great on oil right now. So we came down to about 75. This was on the comments that Trump said, I think, to a CBS reporter on the phone, that effectively that the conflict was almost over. But as we've seen over the week, it's clearly not almost over. I think people are putting less and less weight on what the administration says, because they've put out a lot of things which haven't really proved to be true on this conflict. And I think again over the weekend, maybe the energy secretary, I think, said that things should be coming to a close over the next few weeks. So there's a lot of different comments, contradictory statements, but however long this conflict goes on for, it's going to increase the price of oil. And then just one final thing to mention is I found this from last week now. So this is the effectively like the oil VIX. It's the oil volatility index. So you can see it's spiked super high. So it's higher than it was when Russia attacked Ukraine. Obviously, it's nowhere near COVID. That like COVID's at that the absolute gigantic bar there. But I know it's a bit small if I'm trying to zoom in. But you can see it is still really high compared to its general historical level. Even in 2008 area, it was lower than this. So during the the Great Financial Crisis, it didn't reach the levels we're at now. So it just does just show you how much volatility, general uncertainty in the oil and the gas prices as well right now. So I did mention it, but sort of leading into like the main topic of the week, something major did happen on Friday evening. And as Trump has done recently, many times, he does these big market moving events on a Friday night. I'm almost certain it's to try and give as much time as possible for the markets to digest the news, because to actually get into it, effectively the US bombed the hell out of Kharg Island. And if you haven't heard of Kharg Island, I'm going to show you how small it is. So if we zoom in, it's this little speck here. This island is what was heavily bombed over the weekend, and I think still being bombed now. The reason why it's so significant is because this is effectively the hub of Iranian oil and gas exports. 90% of their gas, 90% of their oil leaves this island. I think 15% of China's imported oil comes just from this island. So there's the if we go here, kind of see it. There's these all the oil and gas infrastructure around all the massive oil and gas fields in this area, which I'm circling now. But because of geography and because of how things have worked out effectively, there's a huge risk for Iran that have left themselves a bit exposed here. But this island is absolutely critical. So over the weekend, as I was saying, like Trump does tend to do these market shifting events on a Friday night for maximum time for the markets to kind of like take in the shock and then not be as reactive when the futures open on Sunday night. They've only been targeting the energy infrastructure. So Trump said that for now they've just targeted the oil and gas infrastructure, and this is super important. So I know we haven't got loads of pictures because obviously they're a hostile nation, but this area here, this is for the medium-sized tankers. So there's this big port here on the right side, on the east side, and the super large tankers go here. But then on the west side over here, this is the very large crude tankers, I think it's called. So these are the absolute biggest. So this is a deep water port, effectively. One of the reasons why it's not done inland, because the nature of the Iranian coast is that they can't have the super large tankers. Like, it's just not a deep port. Like, there's no deep ports, there's no deep water. The coast isn't suitable for a large port, but this area is. And just like the way gravity works and the way basically like where like the oil and gas is, there's a lot of flowing into this area, kind of like it's sort of like fairly naturally. So yeah, that's why this tiny island, this really small island, is is so important. So what did that do over the weekend? So I think this is updated. Let's just check. So this is like the live weekend US crude oil futures. So we're almost plus 5%, which is going to put us around, by the looks of it, 103. So if you just go back to the oil, so yeah, so we left at 99.3. We're now at about 103 again. And as I mentioned last week in particular, but 2 weeks ago as well, this isn't good for inflation. This isn't good for many industries. The Nasdaq 100 is down 0.4% over the weekend, just to give you an idea of sort of generally what's going on. But to not repeat myself too much from the last 2 weeks, I thought I'd take a bit of a different approach. So this is like the US polling data. This website, Real Clear Polling, is like a poll of polls. So it kind of aggregates all the major polls and it spits out like the average. So the US population overall disproves the action which is going on right now, Operation Epic Fury. Again, in general foreign policy, it's the same. So they approve about 41.4, disprove 54.5. The reason why I'm mentioning this is because, as I said last week, the US operation is going against 3 super core issues for Trump and the American people. It's the 3 core issues which he actually campaigned on: no foreign wars, stable low inflation, and very low to low gas, or obviously we call it petrol prices. And this is affecting all 3 of those. Again, as I mentioned before, but this action in Iran is in the midterm year. It's currently not ideal timing. So this is Kalshi. This is the prediction markets for looking what will happen at the midterms. So if you sort of look over the last month or so, since this kicked off, the chances of the Democrats taking the House and the Senate have increased, and now that's the favorite outcome of around 50%. The Republicans will lose the House anyway, like that's almost certain. But so the key battleground is whether they'll keep the Senate or not. So right now the Republicans have the House, Senate, and obviously the president as well. So what is going to happen? I'm not sure what you boys think, but I still would overall think that this should be over as soon as possible from the US point of view. But this isn't a Venezuela. This isn't a Tara situation. It's not easy just to tackle. This is a very hostile area. There are militant groups in the area. Now the Houthis are threatening to close I can't remember the name. The
Bab of something in it.
Yeah, the Bab al Mandab Strait. So like the Houthis are a terrorist group which operate in this part of Yemen, and they're threatening to close this strait, which affects oil and gas even more because this is where the Suez Canal is. So this,
another 12% passes through there, 12% of the world.
Yeah, so this is a key critical choke point as well. So with the Strait of Hormuz shut and what is it again? The Bab al Mandab Strait shut.
I'll call it the Bab Strait.
Yeah.
Easy.
So it's difficult. I think Trump's response is going to be going in harder in hoping of just getting Iran to capitulate, but Iran doesn't have a history of doing that. So the leader of Iran is a spiritual religious leader. The US killed him 2 weeks ago now. So obviously that the Iran's leadership isn't going to be happy about that. Of course not. But I think it does come down to 2 key choke points. It is the Strait of Hormuz, and this is Iran's leverage. This has always been Iran's leverage. If you fuck with us, we will fuck with the Strait of Hormuz is effectively how they do their foreign policy, because of how crucial this is. And as we've seen, it's really, really crucial, because if you fuck with the Strait of Hormuz, oil prices go up, inflation goes up. So there's that. But Kharg Island is Iranian's crown jewel of the energy infrastructure. So the US are now fucking with that. It's going to be a standoff. Who knows what's going to happen? The US are desperate for oil and gas to be freely moving on tankers throughout the Strait of Hormuz. I think it'd be unwise to make a true prediction and be able to see into the future right now. But I think Trump's going to probably end up hitting Kharg Island harder and harder and hope they capitulate. But I'm not sure. Like, it is a tense situation. And just one final point on like the more macro lens is that we have got a Fed rate decision next week. As you can see, it's effectively 100% that they're going to hold rate. So we know that's not going to happen on Wednesday. But if you look at the more long-term prediction, so that the market is now only pricing in one rate cut this calendar year, and that is probably going to be in the October meeting. So, and the next rate cut after that isn't going to be into the end of next year, as of right now anyway. So it does just show that how much of an effect this has, because inflation data hasn't been the best already. And now this huge oil shock, we could be looking at higher inflation, less chance of rate cuts, more of a risk-off appetite in the market. So just as a reminder why all this matters and what sustained oil prices might end up doing. Hopefully oil comes down and we will still get 2 rate cuts, maybe even 3 this year. Obviously, Kevin Walsh hopefully is a dove. But yeah, I think it's a time to be prepared for 0 to 1 rate cuts. What do you guys think?
What do you think on this, George? Have you got something to touch on this, or do you want me to jump in first?
I was going to say, just like the Middle East geopolitical situation, it's very clear that there's a pressure on the US that they're trying to, sort of tiptoe around, increase pressure on Iran without increasing pressure back on themselves, sort of like shooting like a rubber bullet at a wall in front of yourself. I think that's clear through their communications. Like when they attacked Kharg Island, they very quickly said that we've only attacked military targets, we've not touched anything or structure-wise, trying to calm and prevent any panic and any then reflection on oil prices and energy. And I think that's kind of like the setting the standard for the rest of that situation, where they are trying to tiptoe as best they can around that energy side to still inflict pressure on Iran. And I think it comes back to that. They don't want it to go on for ages. It's going to hurt them more to go on for ages. I saw some comments this week about how much sort of US energy infrastructure or any oil companies, etc., sort of set to gain this year. Oil prices stayed where they were, and it'd be like upwards of 140 billion extra in revenue, which obviously benefits them, but it's like you're benefiting a very small group of stocks or people, and the wider market outside of that suffers. So it's definitely not anything that's bullish in my opinion. Just for those who are already invested in oil stocks before this all broke out, or thought other ones reaping the benefits. So definitely a situation they're tiptoeing around, definitely one that they want to have resolved, but they're balancing that, the two sides of what happens to them inflation wise and sort of cost wise versus reputation of if they do just suddenly back down and conform and have like a moral loss rather than moral victory, or be seen as a sort of strategic loss for the US, which they also don't want. So two things they don't want are either of those outcomes, and they're trying to balance that in the middle as best they can, which is why I think we're seeing really clear communication, as Will said as well. Like the timing of when things happened, it's quite mad to think that some of these military operations might be dictated by market open and close, but I think that's what we are seeing to a degree, where things are happening on a Friday or over the weekends for a reason, and it's to try and control some of the calm and try and control some of the panic and install some calm in the markets from kind of what progresses and what changes.
See, well, I'll take a little bit of a different approach to this. So obviously I started looking today how it affect China and how it affect other things like that. Now, obviously Kharg Island, most of that oil goes to China, and it's about 1.5 million barrels a day. And obviously we seen reports last week of obviously someone's just put it about the Strait being mined, and then we obviously seen other reports which we don't know how true they are. So it's just a report about Chinese ships being let through. Obviously, it's only an indication of time before you have every ship representing China changing flags, changing transponders, changing the way, obviously. So then you're back to square one. Who are they hitting? Now, I did do a little bit of research, and Kharg Island, wherever you pronounce it, to the Strait of Hormuz is about 1,000 kilometers, which is obviously quite a journey. So if you've got every ship that's trying to duplicate being Chinese, etc., you're going to be hitting friendly targets if you're trying to hit anything that's not Chinese. So it took a little bit of a different. Obviously, China are going to want that open as soon as possible because actually they're probably feeling it a lot more than most people if they're not getting their full shipments that are coming through. And obviously, Will, I know you touched on it as well about the Bab Strait being shut as well. Obviously, if both of those shut, it's going to be a real chokehold.
Yeah. Yeah, so I did just see some comments in the chat as well about letting Chinese ships through, sort of as you mentioned, Jay. But I think it's just be very wary, guys, of any of those headlines, because right now Iran doesn't have that capability. It's saying and doing anything to try and put pressure on the US to stop the conflict, to via China or other Gulf nations to put pressure on the US, but also they haven't got control of the Strait of Hormuz. I'm not saying that anyone does, but they haven't got ships or marshalling ships to organize who comes through and who doesn't. It's just see a ship, yeah, maybe we might hit it, maybe we might not. So I would take a massive pinch of salt of what the Iranians are saying, because they're going for their classic scorched earth policy, as I mentioned, with the whole, if you screw with us with the on the Strait of Hormuz, then we'll, if you screw us in general, we'll screw with that strait. So that's sort of what they're doing. And I saw someone mention mines as well. Yeah, there has been talk of mines. I'm not sure that's confirmed or not, but even just the mention of mines means lawyers won't want to put the insurance on the ships, and ships won't want to go through really, for fear of risk of that. Just a slightly pivot. One rumor I saw, but it was in the FT and Bloomberg, so there was some credibility to the rumor, but it is still rumor, so this is not confirmed. But I did see that there's rumors that the US Treasury are shorting oil futures to try and keep the price down, to suppress the price of oil, because according to some people, it kind of would have to be them because of how much amounts of dollars are actually currently being used to do that. If that is the case, and as I said, this is not confirmed, this is just allegedly, but if that is the case, that is an extremely dangerous game. I did see one report that it might be that they're thinking about it and haven't actually done it. I truly hope that they have not done it, because if oil keeps going up and they're net short, then there's going to be an almighty short squeeze and oil's going to go absolutely through the roof. So I hope that they just thought about it and didn't do it, because I think that could be catastrophic. But Scott Bessent has got a incredible track record of stabilizing and or destabilizing certain things. So I mean, if he's leading it, I'd probably be slightly more sure in it, but I don't think any sensible person wants that to happen at all.
Yeah, and that's what I mean. I mean, obviously, like you just said, well, if barrels have all start going to 150 and the 200 mark, like I've heard some people, like say again, reports talking about that again, I think that'd be a crazy place for the markets to be in.
I think
bullish alphas in the UK. Everyone will be buying a bike.
I think if there was like a really big short squeeze, like all just go like completely parabolic, but I don't think that will happen. But as it's dragged on further, we are gonna see things disrupted for weeks and months now. Not necessarily hugely disrupted, but if it ended tomorrow, it's not gonna, like, things won't go back to normal tomorrow. Like, it's gonna take weeks and months for wells to be reopened, things to be restarted, pipelines to be reopened. But also obviously things like fertilizer, helium, petrochemicals, kerosene, all of these things are being affected. So ultimately, as I've said the last 2 weeks, the reason why we're covering this is because it's hugely topical and it is the main story. As long-term investors, I don't think it's really a big deal. As we've seen before in the survey, we've discussed about those, those charts which show every major event on the S&P 500, and there's literally hundreds of them, but over time it does trundle upwards. So from from a long-term perspective, it's a chance to buy the dip, but in the short term and in like the near 12-month term, it does affect inflation. It does affect what the Fed can do, which obviously therefore affects stocks. So it does have knock-on effects.
I think something that's interesting to touch on that, Will, what you just said as well, is helium was already going through the roof before this happened. And obviously, since this has happened, it's obviously been going up a lot more. So it's interesting to know how much actually products helium going to. Won't touch on it now, but if people aren't too sure about that, it's worth looking into to see how much helium actually goes into a lot of products. You having fun now, Will?
Yeah, I was going to show you. So this is the thing I was talking about. It's just like a chart which shows you just how many things have happened, but the S&P 500 still goes up. So this is only up until 2022, but I guess this is my kind of weekly message of don't be too alarmed. I know what we're saying doesn't sound great, but it's short term, it's near term problems. Over the long term, if you're diversified, especially if you are buying an index, it's fine. But just be aware, like there will be increased volatility over the next few weeks and months, but that's okay. That's just a time to buy, in my opinion.
Now, I think we've touched on it pretty strong, to be honest. Is there anything else that you lads would like to add to that subject?
Are there any questions from anyone?
I haven't seen any questions in there. People are just putting in there basically about the same, about talking about the mines and about obviously stuff like that. So obviously everybody's seeing the same reports, but it's like you just said, well, they are just reports and we don't actually know how much is true and how much isn't true. So it's important, like you say, you take everything with a pinch of salt and just see how it plays out, because ultimately we're sitting at home and there's nothing you can really do about it other than watch and see how those progress. So
Yes, yeah.
Is there anything else you want to touch on that, Will, or are you happy?
No, good, mate.
No, that's good. Right, John, you're going to take over with Oracle's earnings. So we'll pop you up now, John, if you want to take over, mate.
Of course. So Oracle earnings was this week, and it was probably the biggest earnings we had this week in terms of the stocks that had their earnings and the impact they could have on their market segment. So if we look at how it reacted first, it over the last week it is up 1%, but the initial reaction was up between 9 and 10% initially at its peak, and then it's just slowly come back down. So quite an interesting reaction, and we'll get into why. But in terms of the numbers, they beat the earnings per share by 6%, and they beat the revenue expectations by 2%. Year over year, both earnings and revenue was up 22%. So if we look at the numbers, if I go into this further, so the quarter performance, cloud revenue was up 44% to 8.9 billion. Cloud infrastructure revenue was up 84% to 4.9 billion, and cloud database was up 35%. And they have a remaining obligation of $553 billion, which is up 325% year over year. So that's a massive climb. And most of the equipment for this remaining obligation is already funded up front by prepayments, or the customers actually supplying the GPUs themselves. So I thought that was quite positive to highlight. This is the first quarter in 15 years where they've had a total revenue and non-GAAP earnings grow organically of 20% or more. And then software revenue was only up 3%. So whilst I've had a lot of positive growth, I think it's still key to try and highlight that software revenue was only up a little bit. Guidance going forward, they have bumped the guidance up a little bit by 1% long term, 1 billion, long term, which isn't a lot, but it just reiterates how how much conviction they're really showing in this. But for Q4 2026, they expect revenues to grow 18 to 20%, cloud revenue to grow between 44 and 48%, and non-GAAP earnings per share to be growing between 15 and 17%. So still quite a lot of strong growth to go for the rest of the financial year. Like I said, for the fiscal year 2027, they're raising the total revenue guidance to $90 billion. This is only up $1 billion in total, but it is a rise, which shows that they've still got a lot of conviction in the earnings. So the key takeaways from the release itself, I am going to go through the call as well. They've got a 15% stake in the TikTok US with a seat on the board. From what I can gather, they're not really getting much from it apart from their supplying the tech, so they'll be getting the earnings through that, but they've got a seat on the board, which probably is a key thing for them. Over the 20% organic growth in revenue and earnings per share, that was quite positive. The guidance increase, which signals conviction, and most of the equipment funding is secured upfront for the remaining obligation, which takes away a lot of the risk of not being able to afford that capital plan or having to dilute shares further or take on more debt to fund that. So in terms of the earnings call, they raised $30 billion through investment-grade bonds and mandatory convertible preferred stock. They could have raised more, they said, but they decided that $30 billion was enough, and it shows that a lot of people are willing to give investment to Oracle to fund their expansion. The AI threat to SaaS only exists if you don't utilize AI, is what they've come out with. And they said they are doing this, and they're doing this really well. So they've got a bunch of smaller teams building new softwares and AI agents in a more efficient way. And they're going to look to embed AI agents within the software and within the tools that they provide the customers, which they think will set them apart long-term from the rest and will be a less threat of AI taking over SaaS. They had a lot of major wins against SAP and Workday. They announced 2,000 contracts or 2,000 customers went live in Q3, which was quite a lot. The time to go on live is getting shorter, which will obviously be a better selling point going forward. And customers are already going to them and asking, how can we automate the whole ecosystem? So the product is getting even more sticky than it was before, and AI is starting to help them automate everything. But we will get onto that because that's an interesting thing within itself. And then AI infrastructure, I've just left it at that bullet point because there's a lot. So they're growing the regions quickly through Microsoft, Google, and Amazon. They're getting locations everywhere around the world, which feeds into sovereign AI a little bit more. They'll have over 10 gigawatts of data centers coming online in the next 3 years, which is a massive amount, and should hopefully start to produce that backlog of customers into actual recurring profitable revenue. And more than 90% of this is already funded through the likes of prepayment or customers supplying their own GPUs. They've tripled manufacturing sites and increased rack output by 4 times, and the time to rack itself has reduced by 60%. So they're able to put up these data centers even quicker. Q3, they delivered 400 megawatts to customers, and gross margins remained above guidance of 30%. So the gross margins were actually at 32%. So they're more profitable and they're getting more efficient with this AI infrastructure anyway, which is the big worry of how much capital the AI infrastructure is outlaying. They're still able to remain at a good profit. So if we get on to analyst questions, and this is where the big commentary came from, and there was quite a good few questions, as you would expect from the professionals. One thing I wanted to highlight was the CEO said we were faster and cheaper than everybody else, which I thought was a good comment, but I think a lot of people in the space are saying that they're faster and cheaper than everyone else. They reiterated only $50 billion of capex for this financial year, but they said they will wait to discuss 2027 capex. They don't want to discuss that yet. They want to wait for the next quarter orders. So maybe there's a little bit of uncertainty around how much they're going to spend next year and how much that's going to eat into the bottom line. But I think a lot of people were also pleased that they're not going to have to spend more on the capex this year, because that spend is already a worry for a lot of people and the way it's being financed. They made quite a big comment around inference and how it has grown. So they're saying that there's more more use cases are being discovered by the day, and tools like Claude are changing the way we are working, which feeds into inference, which means there's more demand for inference going forward. So if they see a lot of growth in that, obviously that's going to be a lot more positive for them. They said, so there was a big question around the location of the data centers and if that has an issue on how quick and how well they can supply the customers. And they said the location wasn't an issue. The main issue was power, obviously, but latency issues as well, which they think is caused by hardware, not data center location. But what I thought was quite interesting is they said to look out for key announcements at the GPU conference from NVIDIA this week coming. So maybe that's a foreshadow that NVIDIA's got some nice announcements this week. They said the only drag on profitability is the construction of data centers. Once it is up, it is already contracted at a profitable rate. So that's quite positive for all the shareholders. They've said AI is disruptive, but will not kill SaaS. Oracle themselves have over 1,000 agents in Fusion, with hundreds in the banking suite. And they are giving these to customers with no further cost. So obviously that's a better selling point for Oracle. And customers are wanting to know how they can utilize these already. So they were winning a lot of customers off SAP and Workday. And if customers are seeing the AI use in their models, then that's even more beneficial for them. It keeps all part of their business ecosystem at the top of the market. And what I found was really interesting, which I haven't seen elsewhere, customers have full control on where and who creates those AI agents. So what they're saying by that is they can use the ones that Oracle have and use the Oracle suite to create them. They can create their own, or they can pay a third party to go and create AI agents. But they are welcome to accepting any AI agent, no matter who or where it's built. And I think this increases the attractiveness of the Oracle product, because it means you're not stuck down one vendor. You can try different things, or see if Claude is going to take off even further, you can get AI agents built by Claude that'll communicate with the Oracle products and sit amongst them. And one good note that I think was quite good from Larry, who is the chairman and CTO, if you weren't aware. He said, "We think a SaaS apocalypse applies to others, but not us." So I think overall it was very good for Oracle. I think for the broader market, it shows that the demand is still there, especially with the massive backlog. The sort of shushing the rumors a little bit around the debt issues, but the debt issues will always be a big talking point. But the fact that they can get it up and already be in a profitable space once it's up, is probably a good point for investors. Will, I seen your mic come off mute there, so I imagine you've got a comment against what I've just said.
No, well, I was going to talk, just sort of talk more in general. That just to kind of further highlight to the viewers that Oracle is just such an important company for the overall AI space. So I was going to make the point that I think if you are bullish AI, sort of by kind of default, you have to be bullish Oracle, really. They're really tied with OpenAI, obviously the massive $300 billion deal with them. And the last quarter for Oracle wasn't as good. Obviously, that the stocks dropped a lot from its all-time high. I think all-time high was around 350-ish, 325. Obviously, now it's around 150, 160. So they really needed a good quarter, and they have covered a lot of what the concerns were. Obviously, Oracle does have a lot of debt. There's a lot going on in general with the company, with OpenAI, but I think Oracle will succeed at being like the fifth hyperscaler, as I mentioned last week, and they are carving out their niche as they're not quite a legacy hyperscaler like an AWS, but they're not quite a neo cloud like a Nebius or a more like a Hive or like an IRN. They have got that kind of key middle of like the best of both worlds in terms of size, in terms of being able to nimble and move and pivot to the next thing, but also access to the best GPUs, the kind of overall reputation, and generally, as you mentioned, like they are working with countries specifically as well, and working on that sovereign AI side really heavily. So it was a good quarter, but I think we will have to see more from Oracle. Obviously, right now the street isn't too impressed by them, I guess. But I think long term, this is a really good company to be a part of.
I would agree, and I think the sovereign AI point, I sort of want to add a little bit further to that. Obviously, a lot of companies want to harvest their own data and get a lot out of that, and this is being pushed by legislation as well. So the EU have set out a framework around the AI market, and then they've got an upcoming Cloud and AI Development Act that would push sovereign AI even more. So I do think it was a very positive earnings for Oracle, like you said, and they're probably one of the biggest in the market. So they have a massive impact on all the players in the market. I think it's nice to see that they've been able to calm quite a few worries, but I think the overall worries in the market is always going to remain and be a question over every earnings going forward for at least the next 2 or 3 years.
I think they are just getting generally tied together with the CapEx worries as well of Google, Amazon, Meta, Microsoft. Like they are just getting put in that bucket of, wow, so much CapEx must be bad. But this build out is needed of the AI infrastructure. They're a major part of it. Jordan, have you got anything else to add to that?
Yeah, I was going to say, I think from the earnings, the CapEx number was one of the most surprising things to me in the sense that it didn't scale in the same way we've seen the other hyperscalers scale their CapEx forecast for the year ahead. But I mean, you've got to remember, Oracle are the smaller entity of those hyperscalers. Their balance sheet is tighter. Their CapEx is already much higher than the others in terms of their percentage. I think their sort of 2026 forecast CapEx is about 75% of their projected revenue, which is much higher than the others. You know, Google, for instance, just went over 400 billion. So they'd be having to spend 300 billion to spend the same portion of their money on CapEx as Oracle is. And I think also potentially the sort of scale up that we've seen from the other hyperscalers in terms of the CapEx, Oracle has already done at this point. They're the ones doing it after Oracle's already done it. You know, we know Oracle's sort of debt ratios that they've held for a little while. I think that's evidence of them having already pushed more aggressively into this scaling up in this CapEx expenditure and this investment into AI and tapping into that boom quicker than the others have. And they're sort of coming not late to the party, but they're now doing what Oracle has already done. So I think maybe that's part of the reason why we're not seeing the same scale up in the CapEx as we saw from the others. And the number was reiterated around about the same and didn't increase anymore because, as I say, they're already spending as a proportion of their revenue and as a portion of the cash that they have, or I guess in Oracle's case, don't have more than the others. So I think we shouldn't like downplay or oversee that. And then the big highlight obviously was the RPO increasing by over 300%. I think there's interestingly some similarities there between Oracle and Microsoft. You know, Microsoft's RPO went up a lot, and they were also largely tied into OpenAI stuff. So there's some similarities between the two. Obviously, Microsoft didn't react too well on the news of how much of their sort of forecasted business and signed contracted work was related to OpenAI. And we know there's wider questions and concerns people have about OpenAI, sort of as a center of that AI space. So yeah, just nothing really as a conclusion there, just an interesting comparison between the two.
No, I think that's an interesting take. And John, how old's the CEO? Is he John?
I think he is 81. I'll double check.
I've just seen the lads talking in the the guys talking in the comments. He's
10 years old. He was born in 1944, so he's seen World War II.
Do you want to just put a picture back up for him again?
I'll put him back up. Yeah, there we are. He does look good for 81. I mean, I wonder if that is a little bit of Botox in his forehead, but I'm not questioning him too hard on that if I ever get to interview him.
No, that's good, man. That's mad. If he's 81 and he looks that good, fair play. He's got some good skin routine for sure. Is there anything else you want to touch on that, Jordan or John, on anything to do with Oracle, or you both feel like you touched everything you need to touch on?
The only thing I'd say is around the capex. Obviously, they've reiterated the same guidance for this financial year. I wonder if they've been a bit tactical in not announcing the capex for next year yet, in terms of trying to calm the worries around the stock and their overall market, because it could change for 2027, because that's the financial year they're going into. But like Jordan said, I think that is the biggest question, really, because shareholders, once a company goes through a massive capex plan, the first question is, when am I going to start to see that return then? So yeah, I just wonder if they're being a bit tactical with that and not announcing it in this earnings.
Someone just said he looks like an old Diego Simone.
It's a good shout.
Yeah.
That's a good shout.
George, you're going to touch next on Meta's drop this week, and you've got some parts there, haven't you? Do you just want to share your screen buzz real quick, mate?
I don't have any slides this week. I'm just going to.
Okay, perfect. No, that's fine. That's fine. I didn't take out.
I've seen someone in the chat has actually just asked about Meta pricing, so maybe this will help give you some food for thought. So yeah, let's talk about Meta. So it has been a slightly rocky week for Meta as a whole, so especially in terms of its share price. And if you've been watching the tickers, you might have seen that on Friday, I think it slid about 4% down. So what's been affecting the share price? And I think there's two major headlines that have kind of come in at once, or at least in the same week, that are affecting and playing on that share price. So firstly, last week, they announced a delay in their next generation AI model, which they've named Avocado. I said in the Discord server they need to get their own naming scheme for the AI model, because I think fruit and veg is already taken by Google with Nano Banana, but they've gone with avocado. And maybe they need to change their naming scheme to be a bit more successful. So there's a delay on that. And then secondly, there were some reports towards the end of the week about a big new round of layoffs that would see maybe around about 20% of their workforce leaving the door from Meta. So those are two big talking points and two big headlines that come out for the stock. And remember that Meta's a company that have spent a lot of the past year bragging about sort of having a year of being efficient and looking to make this efficiency step, and have had a big pivot. You know, we've seen some of the recruitment they've done, the aggressive hiring, the aggressive capex spend they've made, especially through 2025. So they've been pivoting a lot and trying to sort of push through this narrative of we're becoming this really efficient company that's like really attacking the AI space and the potential that it has. So on the tech side, and onto their avocado model. So what is it? Their avocado AI model was anticipated to be their sort of next big frontier moment, if you like, for Meta, launching an AI model that puts them sort of on par with likes of Google with Gemini, OpenAI with GPT, Microsoft with Copilot, etc., because they don't have that at the moment. But a spanner was thrown in the works because they announced a delay in launching that model. So reportedly, there were some internal tests within Meta that showed that their avocado AI model is sort of lagging behind its competitors. Some people saying it's sort of between Gemini 2.5 and 3, for instance. And that's obviously not the newest version of Gemini. And, you know, in this AI race, if you like, in this massive development of AI, being middle of the pack or not being the newest and best really isn't good enough, and especially not when you're spending billions. And AI is moving so quickly that if you release a model that's middle of the pack, in a few months' time, it's going to be well behind middle of the pack. So it doesn't really make sense for them to release something, have this big launch, and then it really not live up to anticipations whatsoever. And then how did they pivot? So Meta pushed this launch from what was supposed to be this month back until at least May or June. So I'm guessing they'll be looking to make some enhancements, train their model a little bit further, see what improvements they can make, and see if they can cut down some more of the gap and they're lagging behind the others that they currently have. There's also some other reports that came through that are a little bit of a shock probably to Meta investors. There were some light murmuring, so you know, obviously, of course, check through this and don't take it as gospel, and it's not a fact right now. But some murmurings that in the meantime they may consider licensing some other technologies as a stopgap. You know, we've seen Apple license Gemini, we've seen other companies license other AI products. I don't think if they are delaying by 3 months, they're really going to look to do that for 3 months. It seems like a silly time frame. But just to bring in some more of the sort of rumors and murmurings that have been impacting the share price, because you know, talking points like that when they're meant to be in the middle of launching their own AI model, when that anticipation to then hear rumors and people worrying about actually they might plug a stopgap with someone else's and one of their competitors' models in the meantime doesn't, you know, spell very well for their own in-house stuff. Then on sort of the efficiency side, so on that report of up to 20% of layoffs, whilst sort of the tech side is slowing down, the cost cutting is also speeding up. So there are reports from Reuters, I believe, and New York Times that they could cut up to 16,000 people. I think that's roughly about 20% of layoffs. And, that starts to raise some questions of why is this happening? Why now? What do the balance sheets look like? What does the capex segment look like? How is all the numbers and money adding up to warrant considering A, making a layoffs, and B, making such a large layoff? They spent a long time acquiring lots of very talented people, and 16,000 jobs aren't going to be 16,000 interns or apprentices or admins or anything like that. There's going to be lots of highly skilled people in there that they spent a lot of money to upskill and train to the point they're at. So it's a big decision to cut that many people out. So as I say, it raises the question of what are the numbers behind that decision? AI is expensive. They're projected to spend 115 to 135 billion in the year ahead on capex and on technical infrastructure. So as I say, it kind of those numbers are sort of brought into question a little bit of how do these match up, and are these the reason for the layoffs, and how tight are the numbers becoming? Then the sort of investor takeaway and why this all matters as a whole. So I think if you're holding Meta, there's a few things that you should potentially be keeping an eye on. I think there's a side of execution risk. Meta is no longer a scrappy open source leader. They're moving towards proprietary and paid models and launching their own AI model. If they can't beat Google or OpenAI on sort of performance, then their path to monetizing that AI model and those AI sort of platforms gets a lot harder and a lot narrower. If you're not as competitive, then it's much harder to bring in the revenue that you expect in your forecasting. And of course, then your expectations change and investors need to adjust what they see, and then it makes a big impact on the share price. Then the capex problem, we spoke a lot this year. It's been a big talking point, probably the main topic of the year besides what's happening in the Middle East, about capex as a whole. And with all the other hyperscalers, it's not unique to Meta. With all of them, the market is asking how much is too much for this capex. As the numbers get bigger and bigger, the sort of nervousness around them also gets bigger. And when you're spending $130 billion a year and sort of, still missing deadlines with your big launch of your AI model, the sort of want to buy and the signal to buy for investors starts to flicker a little bit, if you like. The nervousness increases and the hesitancy increases, and there's less of a demand, less optimism, and less hype around the stock ultimately, because things don't look as assured and things look a little bit more teetering on the edge. I think there is a silver lining. Historically, Meta has had boosted long-term stock price moves from short-term drops. They are a learner, and they revamp things and they improve things all the time. And if Avocado 2.0 then becomes a thing in 3 months' time after this delay, then it's prompted by from something bad, something good comes out of it. And I think there is optimism there. And Meta is someone, they're a massive company, have a track record of making these improvements, making these developments, and recovering and closing in on ground. They've made a lot of progress in the past year. They've clearly closed down on those competitors who had a head start over them and have been involved in this space longer than them quite quickly. And I think some of that is a payoff and reward of some of the aggressive hiring that they've been doing, and the senior and talented people they've almost been stealing from other mega caps. So for those watching, anyone who's invested in Meta themselves or following Meta, let us know in the chat. Are you currently buying Meta? Are you looking to buy Meta? Is the delay with the Avocado model something that's a deal breaker for you? What are your thoughts on the potential layoffs of Meta? I'm going to share my screen just onto some very light touch TA side, just to give you some food for thought. So let me know when it is up on the screen.
There you go, mate.
Perfect, thank you. So I'm going to do this very light touch, and for anyone who's a little bit intimidated at the start by lots of different lines of different colors, just bear with me. So just on a weekly view, these two dark blue ascending lines are just some rough support and resistance lines that I've drawn. And this obviously goes back quite far. So this goes back 3 years for both. So quite long-term trends that have been respected a number of times. And if we look at the most recent share price movement, you can see that that's broken below the support line. So that's potentially something that's a bearish signal. You can see in these previous instances where it's come down to this support line and it's bounced off of it, but this time for last week it came down, it closed below it. So potentially a bearish signal for further drawdowns. But at the same time, you can see here this faint orange line is a 100-day moving average, which is typically decent support, which it's currently sitting on. So although it's broken through this long-term support, it's sitting on a new support line. We've also got this range down here around about 600, which is also typically some longer-term support, and the 200 is much further away. So as always with TA side of things, there's arguments on both sides. There's some short-term bearish signals, there's some short-term bullish signals. We just want to bring in a little bit more TA, a little bit more frequently to help those just get familiar with it, even if it's nothing to act on. And I'm not calling you to act on anything you're seeing here, but just to get more used to seeing some of the charts and some of the TI side, because I think it's always useful. But yeah, as I say, any questions, feel free to drop in the chat. And I definitely, if you lads any more comments or questions around any of the stuff this week for Meta.
So I do agree with essentially most of what you said, really, Jordan, to be fair, but I would cast a bit of a so what vibe a little bit, particularly on the delay on the new AI model, because Mark essentially strongly implied this would happen on the last call, and I don't think many people are investing in Meta. Well, I'm not sure anyone's investing for Meta for avocado, pure avocado play. It's more of their wider infrastructure of implementing AI to increase profitability on their ad business, but obviously also expand into the AI wearables with the glasses, etc. So is it a blow? Yes. Are there murmurings of discontent between high-level colleagues in the AI, what's it called, the AI section of Meta? Yes, but it's definitely not much of a bearish signal to me, to be honest. I'm personally not going to buy more, even though it's right, around my average. I think I've got a big enough Meta position, but I do think it's a nice entry right now, to be honest. This is going to sound awful in one sense, because before I got into investing, I definitely wouldn't have thought this, but cutting 20% of the workforce, unfortunately, and I do mean unfortunately, it is bullish for EPS. It is bullish for the stock price, because there will be more revenue available. Obviously, it is sad that people will be losing their jobs. I don't want anyone to lose their jobs, but just from a pure investor, capitalist point of view, the 20% is a lot. And in the wider context of large job losses, that's another 20k gone, and there's 40% from Block, and there's been loads of layoffs. So from a general macro sentiment, it's not great, but from a pure Meta numbers point of view, unfortunately, it is bullish.
I feel mixed about layoffs. I almost feel like sometimes they're a mixture of short-term bullish, long-term not necessarily bearish, but obviously there is a slight element of a loss of productivity in terms of that many layoffs, and whether they're flicking a switch and that many people are the sections they're in. I think a lot of them coming from Reality Labs and the sort of old metaverse sections, which I know their focus is much less on now. Within big layoffs are 20% of an organization to be let off is massive. And of course, there will be some roles within that they do deem genuinely redundant. I think also people question how much of that is a necessity versus just a preference, and as I say, how do those numbers add up? But I agree with you, for the most part, short term, they are weirdly bullish news, which, as you say, feels a bit weird for people to lose their jobs and to be something good for other people. It's really interesting.
Yeah, I do think, in particularly with Meta, there's two elements. They did overhire kind of post-COVID 2021, 2022. So there is a bit of excess there, which they may still want to get rid of a bit. But also, in theory, all major AI companies like Meta, like Google, like Microsoft, etc., should be slimming their workforce because of AI, or certainly being more productive. I'm not saying that's a good or bad thing, but in theory, there should be slimming in some companies, but gaining elsewhere as we need people elsewhere as new jobs are created. So 20% is huge, but I do think some of that can be contributed to excess from 2, 3, 4 years ago, and some of it can be contributed to just the amazing progress we've seen in Claude, for example. Obviously not Avocado or Llama, but in Claude and ChatGPT and Gemini over the last year or so. So yeah, it's not good, but as a shareholder, I'm not worried about either of those two things, to be honest.
Yeah, I agree. I've got some Meta myself. I've liked the valuation for a while. Not been the main focus to put new contributions into, but watching it very closely for sure. And I had another thought that's just left my mind. I was going to say, just more generally, I think, we're in a market right now where things are twitchy and nervous. So
Yeah.
even though the AI model, of course, isn't Meta's focus, and definitely shouldn't, as you say, shouldn't be anyone's sort of main bull case for being in on Meta. They're big capex, going into a lot of the AI infrastructure space, and then it having relations to there being a delay in their model, as much as they may sort of, test the waters a little bit and sort of prepare people a little bit for those sort of delays. The nervousness then gets triggered by what's all this capex going on if your models aren't being output at the right time and the models aren't performing as well as you thought they would, and all this sort of thing. Lots of nervousness and sort of twitchy fingers on buttons above sell and buy.
Yeah, I think you're so right. I think if this was August, September last year, it wouldn't have mattered as much. But right now we're in that slightly worried about AI vibe right now, aren't we? So yeah, I think that's.
And I think touching back onto what you was talking about before, Will, I think obviously Scott's just said something on the job losses point. Surely this is just the beginning. Every company will be doing this. That goes back to a little bit on that paper you were sharing the other week, Will. Obviously, from a different standpoint of AI replacing jobs, etc. It's going to happen somewhere, but it's going to improve some jobs, isn't it? Not just take them away.
Yeah. I feel like we can't really go too much into that because that's like a 2-hour topic in itself. But I did go into detail 3 or 4 weeks ago on the Citrini research paper, so maybe you can link that. But just like as a quick answer, yes, I think it probably is the beginning of major job losses, but as with all new technologies we've seen ever in the human race, overall these major technology shifts have created jobs. So in the short to medium term, there's going to be shit headlines, it won't feel good, but the numbers will probably keep getting better. But ultimately, long term, I personally have faith and belief that as a human race, as a society, as a culture, we will be able to create meaningful, new, natural, organic jobs from whatever jobs are lost.
For sure.
I think that's a good point. Have you got anything else to touch on that, Will, or George? Anything else you want to add to it?
I was going to say one quick thing on the end of that, because I know we've spoken this section for a little while. Remember that, when we see these big layoffs and job cut announcements from these companies, it's not as if they've started the year at 100,000 people, now down to 80, and the next time they cut, they're down to 60. They're constantly recruiting, and especially these massive companies, they have their fingers in so many different pies, and their focus is in massive sectors, and they shift over time. And I think naturally, as part of their business model, a lot of it is to do with when those focuses do change and when different sectors start to prove more promising, and where the revenue comes from and where the capex is going, and that shifts and changes quite fluidly. Parts of the business that were a big focus a few years ago are less so, and they might be recruiting one section and then laying off another. So I don't know if we shared it in a previous stream, but there's some graphics about jobs for software engineers specifically, and the recruitment from that has gone through the roof. So as much as there's these big layoffs, they're also going to be recruiting quite a lot in other sectors of the business, and other sectors of the business that, let's say, a year ago had 500 people in it might now be on 2,000 people, because that's where the focus has shifted to.
Yeah, I agree.
Anything else you want to touch on, lads, before we move on?
No, let's move on, mate.
Okay, so this was a topic that was brought up in the Discord server the other day, and I know Will wanted to add this in, and it should we be prepared to lose everything that we invest? Will, because I know you added this in, I will let you start on this one, mate, and then we'll jump in after you.
Yeah, so just someone, I think he just joined our server, kind of mentioned this. So obviously, I'm not personally calling out if you are watching. I just thought it was an interesting thing because I've thought about it for ages and I've seen people mention it. But even right towards the start of my personal journey, it never quite sounded right to me. Like I think to me, like being mentally prepared to lose everything is a bit more of like a gambler's mindset. Whereas I don't believe I am a gambler. I don't gamble, and I am an investor. So for me, straight away, I don't think we should be prepared to lose everything that we invest. I mean, most of my net worth is I'm in the stock market. I think there's two main areas where it can be relevant. It's to do with time horizon and asset type. So time horizon, you should only invest what you money you don't need with bare minimum with a 3 year time horizon. So if you're planning to buy a house in 10 years, then I think investing's perfectly fine. Obviously not financial advice. If you're planning to buy a house in 6 months, I don't think anyone would recommend putting money into the stock market. I think people say 3 years minimum. Some people say 5 years minimum, and I think some people at Vanguard say 8 years minimum. So it's about 3 to 8 years minimum that you should be happy for your money to be locked away to give it a chance to actually grow and to ride out any downturns which may occur. Second point is, if you're talking about investing into a altcoin or a moonshot or a very, very speculative, risky asset, yes, I think you should be prepared to lose everything. For example, BMNR for me is a bit of a moonshot. I don't have much money on that. I'm currently down about 60%. And if I lost all that money, it is what it is. But in terms of your core investments, effectively you're a retirement fund. No, I definitely do not think you should accept to lose everything. And there's also that adage that if the S&P 500 or if the MSCI All Country World Index goes to zero, if it does truly go to zero, which is almost impossible, but if it does, then the world is absolutely, you know what, and money's worthless anyway. So
Yeah, and I think so. Everyone's always going to have a different perspective on it, and I think Will's sort of in the same area as me. It's Will for president. I say that every week. I think obviously when you invest, you have to have the mindset of you can only invest capital that you're prepared to lose, which means you shouldn't over leverage yourself where when you're putting in money, it shouldn't be money that you rely on, like you say, to take out in a short amount of time. And there is still the possibility that stocks can obviously go to zero. That's why it's important for people. And I know we don't tell people what to do, but we try and push them in a sense of direction to learn about ETFs, etc., before investing in individual stocks. Because we've seen it with a couple of stocks that have been bought in and people have spoken about, they've been hyped up. And we've seen people outside of the server that have put 30, 40, 50,000 pound in Beyond Meat, for instance, or whatever it was. And they lost 30, 40, 50% of that position. And that's a lot of money.
Not more. Yeah.
Yeah, we've seen a lot of badness. So I think personally, obviously, yes, you should only invest what you're prepared to lose, but you should never have the mindset that you want to lose. Like if you lose everything, it'd be fine, because if you've got that risk tolerance and you do lose it, or you're putting it into real gambling stocks, hoping for a win, like you say, moonshots of crypto and stuff, I think that's messy. I think that's gambling. And I think obviously that's not really investing. There is a real fine line between investing and gambling. And I think obviously you have to make sure you don't cross it. And that's where time, effort, due diligence. And if you get it wrong and you lose, that didn't mean that you gambled and it failed. It means that you just made a calculated error and things didn't go your way. Not everything's a winner. But yeah, that's my perspective on that. John, do you want to go next?
Yeah, I think you hit the nail on the head there. When you are investing, You should only be investing with what you can afford to lose. So you don't need to over leverage yourself, but you shouldn't be prepared to lose everything. If you're prepared to lose everything, you might as well just go down to your local casino and put it all on slots. I think Paul's made a good point in the chat that you can calculate the risk before you go into an investment, and you can sort of weigh up whether it's going to be a good return long term based on the plan. I think I said you could say you make up 200% in a year, and then you see that ultimately drop to 20% of that value. You're absolutely going to be good, and you're not prepared to lose that amount of money. So I think, you've got to go in with the mindset that you can only afford to invest what you can afford to lose, but you shouldn't be taking the sort of risks with that money. You should be doing calculated risks and choosing investments wisely so it doesn't come to that point, because if it does come at that point, you're absolutely going to be shattered. And you hear the stories of the big market crash in the 1920s, people killing themselves because of how much money they lost. You don't want to be in that position, and you don't want to risk all of your net worth on a gamble, or just throw it away as if money is not worth anything, because at the end of the day, money is what makes the world goes around. It's what puts food in your belly and what puts a roof over your head. So yeah, that's my standpoint on it. Don't know what yours is, Jordan.
I'll go quick. So a lot of what you've all said, I agree with. I think the classic saying that a lot of people have about only invest what you can afford to lose, I think a good part of that is to do with separating the emotional side of it. And it's basically, it's trying to disconnect your connection to whatever you do invest. And it's not a case of being fine with whatever you invest, losing all of that. As I say, I think it's just more to promote that emotional disconnect and not have the emotions investing, which I think are the single biggest sort of risk to your long-term investing performance. Definitely don't expect to lose everything, and don't want to lose everything that you're prepared to. And I think if you did wake up one day and you've lost 50% of your portfolio and then it never goes up, you're not going to be like, oh, well, I don't care, because you will. It's 50% of what you invested. I think, it's all one big game of positioning yourself and allowing yourself to have sort of the minimal exposure to the downside, but the maximum exposure to the upside. And a lot of stuff factors into that. And we spoke briefly earlier this week, which we'll probably look into in a future stream, about the skill of knowing when to sell. And I think there's lots of different sort of topics that fall under that. But one of them for sure is when something has gone badly, just knowing when to decide to sort of take that loss on the chin and move on. Because I know some people sort of have the approach of, I'm never going to sell when I'm in the red, and then I'll never make a loss. But eventually one of those red things will always stay red forever. And in that meantime, your money's been sat there doing nothing when it could have been doing something else. So there's lots of different things that fall into it. It's a massive topic, as I say, we can get into on a future stream. But I echo a lot of what everyone else has already said here.
I think Jordan made a really, really good point about it. If it can help tune your mindset, then maybe it's a little bit of a good thing. I think Jay's mentioned quite a few times that he sort of almost thinks that, like, sort of almost forgets that his money's real, kind of in his trading 2-on-2 account. So if it helps you do that, and it means that you stay invested in downturns, like riding through those SoFi, BBAI lows, like if it can help, ride out that volatility, go through that difficult time, and almost like forget it's real in inverted commas, then I think it can help. But also, just one other point of risk as well is that there's also the risk of not doing anything as well by not investing. So don't be put off by the idea of losses to the extent where you don't invest, or you don't invest enough as well.
Yeah, and I think on the back end of that, Will, because I think you're right, and I think my mindset isn't always healthy towards it. I know my partner will be watching this as well, and she'll be laughing about that because she jokes about it herself. I think it comes in to controlling your emotions a little bit in it, as well as, like I say, when you put in money, and but it comes from not over leveraging yourself, not putting, like you say, what you can't afford in there. It makes you be able to have your emotions in check, because once I've just seen a guy in the chat, for instance, who's bought so far and he's in at 25. And obviously SoFi is a lot lower than that now. And if you're really over leveraged in that stock, you've put money in there that you can't afford to, you might panic sell, and then you've just lost a big portion of your position as well.
Yeah, I agree. I think don't be prepared to, but do be prepared to ride down difficult periods, because that's what the stock market does. It's a feature, not a bug. So be diversified, try and be as stoic as possible. It's not hard. It's not easy, but try and be as calm and as stoic as possible. Ride out those waves, and be prepared for compounding to work and for your money to go up over time.
And I think one last thing to touch on that before we move on from that, or anybody else has anything to say, is sometimes I try and look at it and make sure I don't pick too risky stuff, but you look at it a bit like your pension when you're at work. Your pension at work, you'll pay or SIP or whatever. You'll pay contributions into every month or week, whatever. And most people don't even check it, like full stop. Like they don't check it. Like some people don't even really understand it, but they put into every
91% of people haven't even logged in once. It's crazy.
I'm gonna laugh about that because it's like I said, but yeah, there's people around me that like
please,
that too.
everyone log into your workplace pension. Log in. Make sure you're not in the worst shitty fund possible. Even if you only log in once, at least change it to the most adventurous fund after doing a little bit of research. But please log in. Thank you.
And some people's pensions actually come with benefits and stuff as well. Depends on who you're employed for. Well, if you're in a really good company, you could have some really good benefits. But that's another conversation for another day before we start going down a rabbit hole. But we're going to move on from that because we've got something now that is obviously something that we want to touch on. And so James asked a really good question last week. And obviously, if you're not familiar and you are new here, we do something that's called Question of the Week. So if you do want to ask a question or something, we'll jot them down. And then obviously each week we'll ask another one of these questions out. And this week's question was from James. And he asked, what do you invest for? Now, I'll let the other go. We're going to go backwards on this one because we went forwards in it last time. So Jordan, you can go first on this one, mate, and we'll work our way backwards.
So I think a big part of it for me is kind of like a feeling of a necessity too. So we've probably shared a few graphics on previous streams, and I'm sure we'll keep sharing in future streams as well. The track record of those that are invested and those who are able to hold assets versus those who aren't, and effectively the gulf and the gap in sort of the economic prosperity of those people compared to each other. So those who own assets in the long run do much better than those that don't. So it's that feeling of necessity that if you want to preserve your wealth, not only grow your wealth, but also preserve it and, you know, not fall victim to inflation, then investing is kind of the only sort of real solution to that. Investing long term and investing smart to provide that stability and that safety net, really.
And yourself, John?
I think mine's more around the building that wealth. It's probably something that my family hasn't had in the past, so I sort of want to break a cycle and build something going forward. In terms of my long-term individual goal, it is to bridge that gap between retirement and when I actually want to stop working for the man, so to speak. And also the fact that I purely enjoy looking into companies. So for all the time that I spend looking into companies, I might as well put my money somewhere, and as Jordan says, try and beat inflation and not lose out to inflation itself, and have that money working for myself instead of working for the bank.
And you will?
Yeah, well, classic. Jordan and I seem to have a very similar answer on a lot of things, because that's basically exactly what I was going to say. I think ultimately there is no other choice because of inflation. Like, I think you just have to invest. Because inflation trickles up 2 to 3% every single year, I feel like I have to invest. Like, now I know about it. Obviously, I'm only about 15 months in. Now I know about it. I have to invest until the day I die, because otherwise my money is losing value every single year by 2 to 3%, generally on good years. So I feel like I have to. Martin Lewis on it, I think on his show like a few weeks ago, showed that if you'd put money into the best cash interest rate savings since 2016, in the absolute best, so like you kept switching, you'd actually had less money than what inflation's worth. So inflation eats into cash. I feel like I have to invest. And by investing into stocks and shares, not gold, Bitcoin, houses, property, etc., stocks and shares is the easiest, cheapest, simplest way to do it. So that's why I do it.
See, mine's completely different to all yours. I don't really care about inflation or any of that type of stuff. Mine pretty much comes from background. Mine comes from a completely different perspective. I don't want to repeat the same way that I grew up. So obviously I want to make sure I retire at a decent age, 45, 50 latest, enjoy actual life with my partner and my family, not when I'm 68 and my legs don't work anymore, and be able to do that type of stuff. So it's more about the enjoyment of life, not anything to do with like the economical side. It's more about being able to finish on my terms and do things when I want to do them and how I want to do them. So that was question of the week with us, guys. And obviously, if you do want to ask one, and we'll stick it into the folder, we've got quite a few stacking up. So obviously, if you do want to ask those going into the weeks ahead, let us know and we will put those in. Where was we up to next? So we're looking forward to the week ahead. Obviously, we've got the earnings and the macro. So we'll have a look at the earnings first. I think that was a good question of the week, by the way, James. I appreciate you asking that one because it was.
Yeah, I like that. And also, even though you would think I think he probably meant like, do we have like a specific goal or target? Which I know you do, Jay, but that's just like the way for me makes most sense to our kind of answer, to be honest. So yeah, I think it's a good question because it's quite a specific question, but it can still be answered in different ways as well.
And I think because we're four completely, well, actually, to be fair, we're quite split into me and John are quite similar, and you and Jordan are quite similar. So it's having different opinions and being four completely different people from four completely different places. I think it gives great perspective because everybody's in different stages of their life. So it's great to have a different opinion on everything.
It's fun. I was going to say that for me, and maybe it's the same for Will, the investing side and the reason to want to invest feels a little bit like a Pandora's box in terms of once you start learning about it. It's almost like stepping on a treadmill and you press a button to see what it does and it starts moving, but then the treadmill's not stopping, and then you start running and you feel like, no, you can't stop running because you're just stuck on this thing. And the more you learn about, this compounding thing that's started ever since you saved your first penny, then as I say, it's almost like you're stuck on a hamster wheel or a treadmill that now you know about it, you can't stop and you don't really have any other choice.
Yeah,
And
I think the great.
Go on, Will. No, you first.
I was going to say, I think the great thing about investing is that it's not a competitive sport where you play from 22 to 35. You basically play from the second you start until kind of like the day you die, or at least what I'm saying is like you are still an investor in your 50s, your 60s, your 70s, your 80s, obviously, hopefully 90s plus. So it's a real life skill, something which you can really do for the rest of your life, and it really makes a massive difference and change. And if you are determined, if you are disciplined, if you take time on it, it can really, really benefit you.
And I think it teaches you quite a few things in life, Will. I think you're completely right. I think it teaches you delayed gratification. I think it teaches you patience. It teaches you how to be more emotionally aware about things as well if you learn from it properly. I think investing, it teaches hard work, patience. I think actually if you take the lessons out of it, because there's a lot of lazy investors that want, oh, Will, what's the best stock to buy right now? There's a lot of that type of investor, and there's a lot of investors where it's Jordan. So you've just spoken about this. How can I learn about that? And there's two different types of investors. I have people send me messages all the time, and obviously some of them they feel like they're getting on my nerves, but they're not. And I know you do too as well, Will. They're not, because obviously they're asking really good questions, and it's a privilege really to have those people asking me those types of questions. But yeah, I think it can teach you a lot of life skills, to be honest, investing, and a lot of things can come from it. So, yes, that's right. So obviously we're going to look at the earnings for going into next week. Is there anything that you're watching on here, Will?
Micron. So I think there's 3 for next week, which I'm going to be keeping an eye on, but I can't see the other 2. So Oklo, Micron, and maybe someone else can see it. I can't quite say it right now. But basically Micron, big memory name, big AI memory name. So that's going to be very interesting. Like they're kind of not reminding me, because I wasn't actually involved in them, but from what I've read and understood, they are giving me sort of 2022, 2023 chip name vibe. So they could like really explode this earnings, sort of be the next AMD. But yeah, so mostly focus on Wednesday. But honestly, overall, like we are coming to the end of earnings season, so I think this is like the last major week. Obviously, Oak closed the sort of nuclear play as well. So, but they're not profitable yet. So I think it's more about what's said on the call as opposed to the actual numbers. And then I'm not sure if anyone can see anything else on there.
It's not Alibaba by any chance as the third one, is it?
I think I was thinking of Lululemon as well, because that's a bit of a retail sentiment indicator, kind of, because it's such it's such a strong brand in the US for that upper middle class. And then also Red Cat. Jay, is that a bit of you for Wednesday? Keep an eye on the
just
enemy.
fair to say, Cho's just put it in there as well. Red Cat I'll be looking at, completely different market to Ondas, but it will be interesting to see how their business and their core business is moving. I know obviously he has been on Amit's stream a little bit lately, so I'm assuming that you've seen that as well, Will. He's not a bad bloke, actually, to be fair. The CEO, he's quite an all right guy. I haven't watched the latest one. I did hear that he rambled a lot, but he's quite a good bloke, to be honest. Eric speaks well of him as well. But yeah, that's mainly one that I'm watching next week. Not too much in there that I need to pay too much attention to for my own stocks, but yeah, I will be looking into Red Cap myself personally. Yourself, John?
Micron is probably the most interesting one, but I'm not. Honestly, there's not quite a lot there that I'm interested in this week. If I'm brutally honest, like Will said, Lululemon's probably the one for the middle class to see how they're spending. But there's not much for me there.
No, it makes sense. So we've touched on that bit there. So obviously, a few things going on next week. Obviously, I should probably get the screenshot ready for this next week because it's a bit zoomed out, isn't it?
Well, I actually changed it again because it didn't have number 2 in, which I think is the biggest thing for next week. So
yeah, it is. It is a big event that happens. Like you are right. So markets react to US strikes on Kharg Island. So obviously we'll see that in the futures. Well, actually it's 10 p.m. So in the next half an hour. NVIDIA GTC event in San Jose. Yeah, I said that right, and I will. That one's going to be interesting. There's always a lot that happens at that event. We've got the February pending home sales data on Tuesday, the PPI inflation data for February on Wednesday, the Fed interest rate decision and statement on Wednesday, which we already know where that is, Philly Fed manufacturing index on Thursday, and the January new home sales data on Thursday. Will, what's your take on next week for the macro, mate?
Yeah, so there's a few things to touch on. Just going to the Fed interest rate on Wednesday, we know they're going to hold rates, but we need to basically see how hawkish is Jerome Powell. That basically means how does he sound in terms of, are there going to be any rate cuts effectively? So hawkish is more increasing rates, dovish is more decreasing rates. Obviously, futures tonight will be interesting about oil prices, and that will be generally a massive theme of next week. PPI is important as well. There's so much inflation data all the time from the US, but yeah, PPI and data. But NVIDIA GTC is where my focus is going to be on next week. Honestly, partly because it's a bit of a nice break from this Middle East, Iran oil crisis, because I do love geopolitics, but I have found this one a little bit tiresome just with the way it's been handled by the US, like in general. So NVIDIA GTC, tons of like general announcements. Is going to have a big effect on the AI market, the chip market. Vera Rubin's going to be fully demonstrated and showed off. They're going to have discussions about sovereign AI, about agents. They're going to show off probably some things like we're not even aware of. They're going to mention loads of companies which we know, like I'm sure in their presentations, Nebius, Iren, CoreWeave, Amcor, TSMC, loads of companies are going to be mentioned. They mentioned Grok, their 20 billion purchase recently. That's GROQ. They'll mention that as well heavily, I'm sure. NemoClaw, physical AI, like general looking at that massive market, FSD again. So this is a 4-day event. Jensen will be there doing a couple of big speeches, and this is a market moving event, a massive, massive event for the AI, chip, memory, general future sectors, I suppose, robots, cars. It's not in the best environment. So obviously, if oil was super high, then it would Jensen won't be able to move the market much. But just in terms of for like future announcements and future ideas, where the future of the world's going, this is going to be an event well worth checking out online, particularly for the Jensen Huang keynote speech.
Anything you want to add to that, Jord?
No, just echo the same. Like on the NVIDIA GTC, it feels like maybe 10 years ago where the Apple event seemed to be the most anticipated tech-related thing in the calendar. It now feels like it's switching to NVIDIA. Yeah, outside of that, like as always, inflation data is always something that particularly I look quite closely at. And then, of course, more generally, just how things in the Middle East unfold and progress throughout the week. I agree with Will, as much as it's sort of like it's nice to have other topics to look at for sure and have a break. Of course, that one will still be we'll be fighting with NVIDIA for the sort of biggest market mover of the week for sure.
Anything you want to touch on that, Jord, or you, John? Sorry, or are you about the same as everyone else?
I am about the same. I just want to highlight that people remember when the inflation data comes out that Iran war hadn't started yet, so there won't be any impact from that side. We probably won't see the massive impact for a while, but it'll be all of that data is pre-oil prices rising quite a lot. Just some people might forget about that.
Yeah, which actually think arguably makes it slightly worse because the actual inflation data hasn't been the best. It's sort of between 2.4 and 3.2, depending on which type of inflation data you use. So it's already above the 2% target. Add in 110, 150, $90 a barrel. That's adding on 0.5 to 1%. So yeah, great point, John.
Thank you.
Right, yeah, then. So the last part of the stream. Obviously, we're going to go top to bottom. John is at the top at the moment. So, John, what's your predictions for next week, mate, and why?
I think it's quite a tough one because I think the macro data is a lot more important this week, but then the NVIDIA event would cause quite a push. I am going to go green this week. I think we've had quite a bit of time to digest the Kharg Island stuff, and I don't think the reaction is going to be as bad as what people might be expecting. And I think everyone gets a boost if the NVIDIA announcements are exciting. So this is totally weighing on the NVIDIA event being an exciting event for all the companies involved. So green.
Yourself, Will?
Oh, it's a difficult one, but it always is. Like I guess my sort of thinking is, will the Strait of Hormuz be cleared in any way in the next 5 days, like 5 or 6 days, effectively? On like a yes or no, I'd have to say no. So therefore, do I think at least in the very near term oil prices go higher? Yes, especially with the Kharg Island bombing of the military targets. So therefore, I think I'm gonna go against what I usually do and go for a 4th week of red, which we haven't seen since early March last year, 12 months ago. Yeah, so I do think it'll be red, bearish, Strait of Hormuz, choke point again, unfortunately.
See, I'm in the same boat as you, Will, but I think...
Well, hopefully that boat isn't around the Strait of Hormuz.
I think it's going to open higher than what we expect because of Trump, obviously, well, the news of what's just come out about the fact that there might be some sort of coalition for the Strait. I think we will end up with good news towards the end of the week. Obviously, you've got NVIDIA stuff going on this week, and I think stuff will maybe try to lighten up. And if they do come up with a coalition to make Strait work, yeah, I think obviously that could be bullish for the market. Whether stuff starts getting blown up is a different question. But so I'm going to go green.
It's really hard because on one hand, I want to go green just because this many red weeks in a row is quite rare, as Will mentioned. I think we last week did close off semi-bearish, as in it closed more or less at the lowest it'd been for the week.
Yeah.
The sentiment going into the weekend was quite low on a market-wide basis. I'm kind of blabbering just to try and figure out what I want to go with, and I really don't know. I am going to. I think there's still a little bit of room for further red. Like it's not. We've had red weeks, but they've not been overly massive. At least not like what we saw at the start of last year. So I'll go red again.
Very split, very split. Right, so the stream obviously have done their voting. It was quite balanced for a long while, but 62%, so just over 50 people went green. So you've got me, John, on the stream going green, and Will and Jordan going red. So that'll be interesting to see.
If it goes off the stream's performance, we're going to be wrong.
Stream haven't been right up there, to be fair. If anything, they should definitely be taking more advice from us guys. So, but yeah, Paul said I'm going opposite to the stream. Well, no, that's been another great night. Again, thank you everybody for tuning in. We can see the count going up every week, so we do really appreciate some great questions being asked. Obviously, the question of the weeks are good. So if there is any questions of the week that you want to ask for next week, don't forget to put it in the comments. We will pull them. We have got quite a few to get through already anyway. But no, we appreciate everybody and thank you very much for tuning in.
Thank you.
Yeah, thanks, guys.
Thank you, everyone.